Supermicro saw its stock plunge more than 16% in early Wednesday trading after delivering quarterly results that once again fell short of Wall Street's expectations, reinforcing a growing narrative that while the company is positioned at the center of the artificial intelligence infrastructure boom, it continues to struggle with execution, margin stability, and operational consistency. For investors who had piled back into AI-themed equities over the past several months, the report served as a sharp reminder that exposure to the AI trend alone is no longer enough to justify premium valuations. Markets are now demanding precision, predictability, and clean financial discipline. The reaction was swift and decisive because expectations were high, and when companies trade at growth multiples tied to transformative technologies, even small deviations from projected performance can trigger outsized market responses. For its fiscal fourth quarter of 2025, Supermicro reported adjusted earnings per share of 0.41, below the 0.44 analysts had anticipated according to Bloomberg consensus estimates, while quarterly revenue came in at $5.76 billion versus the $6 billion expected. More importantly, gross profit totaled approximately $551 million, materially below the $601 million forecast, signaling margin pressure that investors cannot ignore in a hardware-intensive, capital-heavy business. In high-growth AI infrastructure markets, revenue growth alone is insufficient if profitability begins to compress, because the sustainability of expansion ultimately depends on efficient production scaling, supply chain reliability, and disciplined cost management. When margins narrow during periods of supposedly strong demand, it raises concerns that either costs are rising faster than anticipated, competitive pricing is intensifying, or operational inefficiencies are limiting conversion of backlog into recognized profit. Looking forward, the company's guidance created an even more complex picture. Supermicro projected adjusted earnings per share between $0.40 and $0.52 for the first quarter of fiscal 2026, notably below the $0.59 analysts were expecting, reinforcing fears that profitability challenges may persist in the near term. However, management simultaneously projected revenue of at least $33 billion, exceeding the $30 billion analysts had forecast, suggesting that demand for AI infrastructure remains robust and that customers continue placing large-scale orders. This divergence between strong top-line expectations and weaker bottom-line guidance underscores the central dilemma facing the company. It appears capable of capturing demand, but is struggling to translate that demand into high-margin, predictable earnings. In equity markets, especially for growth stocks, consistency between revenue expansion and earnings scalability is critical, and any disconnect tends to increase perceived risk. Wall Street's reaction reflected this frustration. Analysts at JPMorgan described the report as yet another quarter in which execution fell short of management's stated targets heading into the period, a phrase that carries significant weight because credibility is one of the most valuable assets a growth company possesses. Markets can forgive supply disruptions, macroeconomic volatility, or temporary headwinds, but they are far less tolerant of repeated guidance misses that suggest internal forecasting challenges or structural operational weaknesses. Over time, patterns of underperformance erode investor confidence, compress valuation multiples, and increase the volatility premium applied to the stock. Supermicro's importance within the AI ecosystem stems from its early positioning after the launch of ChatGPT in 2022, which triggered an unprecedented surge in demand for AI-optimized servers capable of training and running large language models. The company rapidly scaled production of high-performance server racks designed around GPUs from Nvidia, whose chips have become the backbone of modern AI compute infrastructure. This strategic alignment allowed Supermicro to benefit directly from the explosive capital expenditure cycle undertaken by hyperscalers, enterprise clients, and data center operators racing to expand AI capacity. During the peak of AI enthusiasm, investors viewed the company as a leveraged play on Nvidia's dominance, effectively serving as a key hardware integrator translating chip demand into complete deployable systems. Yet even in high-demand environments, operational friction can quickly disrupt performance. CEO Charles Liang attributed the earnings shortfall to capital constraints that limited the company's ability to rapidly scale production, as well as specification changes from a major new customer that delayed revenue recognition. He also cited supply chain bottlenecks in receiving Nvidia chips, which constrained server assembly throughput. While supply limitations in AI GPUs have been a recurring theme across the industry, Investors are increasingly scrutinizing how effectively each company navigates those constraints, allocates capital, and manages working capital cycles. In competitive markets, the difference between sustained growth and margin erosion often lies in operational agility. Complicating the fundamental narrative are governance concerns that have cast a shadow over the company during the past year. A report by short-selling firm Hindenburg Research accused Supermicro of accounting irregularities, export control violations, and questionable relationships between executives and suppliers, triggering heightened scrutiny. The company subsequently delayed filing required quarterly and annual reports with the U.S. Securities and Exchange Commission, placing it at risk of delisting from the Nasdaq and further unsettling investors. Reports of a Department of Justice probe into accounting practices, combined with the resignation of its accountant, intensified concerns and contributed to a sharp decline in the stock into late 2024. Although Supermicro ultimately avoided delisting and resumed compliance, the episode left lingering doubts about transparency and internal controls, issues that can weigh on valuation even when revenue growth remains strong.